Never trust someone who promises you'll always win. Because on December 11, 2008, a man who spent decades convincing the world he had the secret to beating the stock market finally admitted the truth to his own sons. And what he told them would destroy thousands of lives, wipe out charities, cause multiple suicides, and expose the largest financial fraud in human history. This is the story of how Bernie Madoff stole $65 billion. How he fooled the smartest investors on Wall Street for over 20 years. How a whistleblower tried warning regulators 9 times and got completely ignored. And how regular people lost everything while the government agency that was supposed to protect them literally looked the other way. By the end of this video, you'll understand exactly how Ponzi schemes work, why even intelligent people fall for them, and the red flags you need to watch for because schemes like this are still happening today. We're going to break down the actual mechanics of how Madoff pulled this off, who got scammed, and what happened when it all came crashing down. Who was Bernie Madoff? Bernie Madoff wasn't some street hustler. He was Wall Street royalty. Born in 1938 in Queens, New York, to Jewish immigrants, Madoff started his investment firm in 1960 with $5,000. He saved from working as a lifeguard and installing sprinkler systems. Bernard L. Madoff Investment Securities started small, but Madoff had ambition. He pioneered computerized trading systems that revolutionized how stocks were bought and sold. His firm became one of the largest market makers on Wall Street, handling billions of dollars in trades. He served as chairman of NASDAQ not once, but 3 times during the early 1990s. He sat on boards. He donated to charities. He was respected, connected, and trusted. Think about that for a second. This wasn't some random guy cold calling you about crypto. This was someone who helped build the modern stock exchange. When Madoff told you your money was safe, you believed him because he had spent 40 years building credibility. And that's exactly what made him so dangerous. The 2 faces of Madoff's business. Here's where things get interesting. Madoff's firm had 2 completely separate operations. The first was legitimate. The market-making and proprietary trading business operated on the 19th floor of his Manhattan office. This part was real. It bought and sold stocks for clients, made money on the spread between bid and ask prices, and employed hundreds of people including his brother Peter and his 2 sons, Mark and Andrew. This business was profitable and legal. The second operation was on the 17th floor. This was the wealth management division, and this is where the fraud happened. The wealth management side claimed to use something called a split-strike conversion strategy. Sounds fancy, right? Madoff told investors he would buy a basket of 35 to 50 stocks from the S&P 100, basically the biggest, most stable companies in America. Then he'd use options contracts to protect against losses. He'd buy put options to limit downside risk and sell call options to generate income. This strategy is actually real. It's called a collar, and it's used by legitimate investors all the time. The problem? Madoff wasn't actually doing it. He wasn't buying stocks. He wasn't trading options. He was typing fake numbers into a computer and printing statements that showed whatever returns he wanted. The perfect performance that was too perfect. From December 1990 to October 2008, Madoff's reported returns were absolutely stunning. He averaged about 10 to 12% annual returns with almost no down months. His monthly volatility was just 71 basis points. That's insanely low. To put that in perspective, if you invested $100,000 with Madoff in 1990, by 2008, it would have supposedly grown to over $500,000. Steady, reliable, year after year, no matter what the market was doing. During the dot-com crash of 2000 to 2002, when the NASDAQ lost nearly 80% of its value, Madoff's clients were making money. During the 2008 financial crisis, when the entire global economy was imploding, Madoff was still showing gains. This is the equivalent of a baseball player batting .966 for an entire season. It doesn't happen. It can't happen. But people wanted to believe it was real because Madoff was the one claiming it. A financial analyst named Harry Markopoulos figured out something was wrong in just 5 minutes of looking at Madoff's numbers. 5 minutes. He said Madoff's performance chart went up at a perfect 45-degree angle, and that line doesn't exist in finance, it only exists in geometry classes. How the scam actually worked. So if Madoff wasn't actually investing the money, where was it going? Into a Ponzi scheme. Named after Charles Ponzi, who ran a similar scam in the 1920s, the concept is brutally simple. You take money from new investors and use it to pay returns to old investors. As long as more money keeps flowing in than flowing out, the scheme can continue indefinitely. Here's how Madoff did it. Let's say you give Madoff $1 million. He deposits it into his Chase bank account. He doesn't buy any stocks with it. He just keeps it in cash. At the end of the month, his employees create a fake statement showing you made, let's say, $10,000. You're happy. You tell your friends. Some of them invest too. Now more money is coming in. When an existing investor wants to withdraw funds, Madoff just pays them from the pool of new investor money. Meanwhile, he's living large off the funds, taking millions for himself, funding his lifestyle, his properties, his boats, but he needed to hide this from regulators. So Frank DePascali, Madoff's right-hand man who had worked for him since he was 18 years old, created an entire fake paper trail. They hired programmers investigators later called them the computer boys to build custom software that generated fraudulent trade confirmations. These guys were so meticulous that they obtained real statements from the Depository Trust Company, which tracks every stock trade in America, and they copied them. They even hired a programmer to replicate the unique font used on the real statements. They held the fake documents up to windows against the sunlight to compare them with the real ones to make sure they looked identical. Think about the level of effort here. This wasn't a sloppy scam. This was industrial-scale fraud. The whistleblower nobody would listen to. Now here's where this story gets absolutely infuriating. In 1999, Harry Markopolos, a Boston-based financial analyst, was asked by his boss to try to replicate Madoff's returns. His firm was losing clients to Madoff, and they wanted in on whatever strategy he was using. Markopolos did the math. Within 5 minutes, he knew it was fraud. Within 4 hours of deeper analysis, he was certain. The returns were mathematically impossible. The strategy Madoff claimed to use couldn't generate those numbers. The options trades would have been so massive they would have dominated the entire market, and there was no trace of them. So Markopolos did what you'd expect. He went to the Securities and Exchange Commission, the government agency that regulates financial markets and protects investors. In 2000, he submitted his findings to the SEC. They ignored him. In 2001, he submitted again with more evidence. They ignored him. In 2005, he sent a 21-page memo titled, "The World's Largest Hedge Fund is a Fraud." He outlined 30 red flags proving Madoff's returns couldn't be legitimate. He gave them phone numbers of experts who could confirm his analysis. He basically handed them a roadmap. The SEC ignored him. Between 2000 and 2008, Markopolos contacted the SEC 5 times. Each time, they either dismissed his evidence or conducted such a lazy investigation that they found nothing wrong. One CISEC staffer told him he wouldn't qualify as a whistleblower unless he came in with a tape recording of Bernie Madoff admitting he was running a Ponzi scheme. Obviously, he didn't have that tape, and if he did, he wouldn't have needed the SEC. The CISEC actually did investigate Madoff multiple times. In 2005, they examined his brokerage operation, checked his books, and found no evidence of fraud. They were so incompetent that when Madoff gave evasive or contradictory answers during testimony, they just accepted his explanations. Get this. The SEC never made a single phone call to confirm that the stocks Madoff claimed to be buying actually existed. One phone call. That's all it would have taken. An FBI agent later revealed that during one SEC investigation, Madoff and DePascali found that the SEC investigators had left their briefcases in a conference room overnight. So they opened them up, read through the questions they were going to be asked the next day, then printed up fake documents overnight to answer those specific questions. The documents came out of the printer warm, so they had to put them in a refrigerator to cool them off, then pass them around the office to make them look worn. The regulators were so clueless that Madoff literally read their playbook and fed them exactly what they wanted to see. The exclusive club part of what made the scam so effective was that Madoff's investment operation felt exclusive. You couldn't just walk in off the street and open an account. You needed to be invited. You needed connections. Initially, Madoff's clients came from his social circles, country clubs, charity events, Jewish community organizations in New York and Florida. That's when feeder funds entered the picture. These were investment firms that pooled money from multiple clients, then invested it all with Madoff. They charged their own fees on top, making money simply by being the middleman to Madoff's operation. Fairfield Greenwich Group was one of the biggest. They funneled over $7 billion to Madoff. When the scheme collapsed, they had to settle with authorities for $1 billion. The victims ranged from regular retirees to the ultra-wealthy. Steven Spielberg's charitable foundation lost millions. Nobel Prize winner Elie Wiesel and his wife lost their entire $12 million life savings, plus another $15 million from their humanitarian foundation. Kevin Bacon and Kyra Sedgwick lost money. But it wasn't just celebrities. Charities got absolutely devastated. The Pickauer Foundation, which funded brain research and education, was wiped out. They had to return $7 billion that they'd made from the scheme. The Jet Foundation, which funded the Innocence Project to help wrongly convicted prisoners, had to shut down. Medical research grants were cancelled. Hospitals lost major donors. Regular people lost everything. Retirees who had saved for decades found their nest eggs gone overnight. A British war veteran who had lost an arm in combat and survived the French Foreign Legion invested his $1 million life savings with a Madoff feeder fund. When he realized the extent of his losses, he shot himself in the head. Multiple people committed suicide. The collapse. So what finally brought Madoff down? The 2008 financial crisis. When Lehman Brothers collapsed in September 2008 and the stock market went into freefall, investors panicked. Between September and December 2008, Madoff's clients requested withdrawals totaling about $7 billion. For the first time in decades, more money was going out than coming in. Madoff desperately tried to raise cash. He called in favors, reached out to wealthy friends. Carl Shapiro, an apparel magnate, gave him hundreds of millions. But it wasn't enough. By early December, Madoff knew the game was over. The account statements showed his clients held $65 billion in assets. On December 10, 2008, Madoff called his sons Mark and Andrew to his apartment. Both worked at the legitimate side of the firm. He told them he wanted to pay employee bonuses early, several $1 million in total. His sons immediately knew something was wrong. They pressed him. That's when Madoff broke down and admitted the truth. The investment advisory business was all just one big lie. It was basically a giant Ponzi scheme. Mark and Andrew were devastated. On December 11, 2008, FBI agents arrested Bernie Madoff at his Manhattan apartment. The aftermath. Madoff was charged with 11 federal crimes including securities fraud, wire fraud, mail fraud, money laundering, perjury, and making false statements to the SEC. On March 12, 2009, he pleaded guilty to all charges. On June 29, 2009, he was sentenced to the maximum, 150 years in prison. He was 71 years old. The judge called his crimes extraordinary evil. Madoff never cooperated with authorities. He insisted he acted alone, though investigators didn't believe that was possible. His employees started getting arrested. Dipascali pleaded guilty to 10 charges and faced 125 years, but died of lung cancer before sentencing. Madoff's brother, Peter, who ran daily operations and served as chief compliance officer, pleaded guilty and got 10 years in prison. The scandal destroyed Madoff's family. His son Mark hanged himself on December 11, 2010. Exactly 2 years after his father's arrest. He left behind a wife and children. His other son Andrew, who had battled cancer since 2003. Madoff's wife Ruth claimed she also didn't know, though many found that hard to believe. Bernie Madoff died in federal prison on April 14, 2021. He was 82 years old. The recovery effort here is something remarkable. Through an absolutely massive recovery effort, victims have gotten back way more money than anyone expected. A court-appointed trustee named Irving Picard was tasked with recovering assets. His team went after anyone who had profited from the scheme, even if they didn't know it was fraud. The logic? If you withdrew more money than you put in, you were paid with stolen funds from other victims. Picard has recovered about $14 billion through these clawback lawsuits and settlements. The biggest came from the estate of Jeffrey Pickauer, a billionaire investor who had made returns as high as 900% from Madoff. The Department of Justice also created the Madoff Victim Fund, which has distributed over $4.3 billion to about 41,000 victims across 127 countries. In total, victims have recovered approximately 94% of their proven losses. That's actually extraordinary for a fraud this massive. Most victims were small investors. The average loss was around $250,000 per person. How did this happen? So how did Bernie Madoff fool so many people for so long? First, he had credibility. 4 decades of building a legitimate business gave him cover. When someone with his resume and connections promises returns, people listen. Second, the returns weren't outrageous. Madoff didn't promise 100% gains. He promised steady, consistent 10 to 12% annually. That seemed achievable, especially from someone of his stature. Third, exclusivity created desire. The harder it was to get in, the more people wanted to invest. Being a Madoff client became a status symbol. Fourth, he targeted communities where trust runs deep. Jewish organizations, charities, country clubs, places where people vouched for each other and word of mouth mattered more than due diligence. Fifth, and most important, the regulators failed catastrophically. The SEC had multiple opportunities to stop this, and they blew every single one. They lacked expertise, resources, and apparently the courage to go after someone as powerful as Madoff. And SEC Inspector General report after the collapse was absolutely scathing. It detailed how investigators missed obvious red flags, accepted weak explanations, and never verified basic facts. Christopher Cox, who was SEC chairman at the time, admitted his agency had failed. The warning signs if you want to protect yourself from schemes like this, here are the red flags. Returns that are too consistent. Nothing goes up in a straight line. Even the best investors have bad quarters. If someone is showing gains month after month regardless of market conditions, something's wrong. Strategies that are complex but vague. Madoff used fancy terminology like split-strike conversion, but never explained the details in a way that could be verified. Exclusivity and secrecy. If an investment opportunity seems too exclusive, asks you to keep it quiet or makes verification difficult, run. Unregistered investments and unlicensed advisors. Always check credentials. Always verify that the person is registered with the proper authorities. Difficulty withdrawing funds. Ponzi schemes will sometimes make it hard to get your money out or pressure you to reinvest rather than withdraw. And here's the biggest one. If you can't understand how the returns are being generated, don't invest. It's that simple. Warren Buffett has a rule. Never invest in something you don't understand. If you can't explain to someone else how your investment makes money, you don't actually understand it. What changed? The Madoff scandal led to some reforms. The SEC established a whistleblower program that actually compensates people who report fraud, something that might have made a difference if it existed when Markopoulos was trying to sound the alarm. They increased enforcement actions against Ponzi schemes, over 600 cases involving more than 2,000 individuals in the 6 years after Madoff's arrest. But the fundamental problems remain. The SEC is still understaffed. They still lack enough people with real Wall Street experience who understand complex financial instruments. And new Ponzi schemes keep popping up. Harry Markopoulos, the whistleblower, testified before Congress that he's currently working on 3 multi-billion-dollar Ponzi schemes, one of which he says will be bigger than Madoff's. He says we can't stop them because people want to believe in risk-free returns. The takeaway: Bernie Madoff didn't invent the Ponzi scheme, but he perfected it on a scale nobody had ever seen before. $65 billion in claimed losses. Over 37,000 victims across 136 countries. Decades of lies. A man who had everything: wealth, respect, influence, and threw it all away because he wanted more. The most disturbing part? It could have been stopped, multiple times. By regulators who were supposed to protect investors. By colleagues who had suspicions but didn't want to believe them. By investors who ignored red flags because the returns looked too good to question. The Bernie Madoff case isn't just about one man's greed. It's about systemic failures, about the danger of trusting reputation over evidence, and about what happens when we want something to be true so badly that we ignore reality. 3 lessons here. Question everything, especially if it seems too good to be true. Diversify your investments so you're never wiped out by one failure. And demand transparency from anyone handling your money. Because the next Bernie Madoff is out there right now, showing perfect returns, building credibility, and waiting for the moment when people stop asking questions.